Hi, this is Mark from myfreedombank.com. Today we're going to be talking about real estate investing using privatized banking. Why is that? Many of my clients are very interested in acquiring the asset class of real estate, and we like to do that using privatized banking. So the question always comes up, how do we do it? So this is going to be a primer on how to look at an opportunity in real estate, look at the nominal case, and then see how we apply privatized banking to hopefully make it better. We're going to be buying real estate, in this example, for cash flow. Now that's different from buying real estate for appreciation over time, or for what people call flipping in a shorter period of time, making money on appreciation versus making money thrown off by the piece of real estate, usually in the form of some kind of rent on a monthly basis. So we will assume, as I'll show later, that this property will uniquely not appreciate in value. We're going to be looking at a 5-year analysis. You don't have to have the property for 5 years. You don't have to sell the property after 5 years. We're just going to look at 5 years of investment to cash flow and see what that looks like and compare different ways of approaching the opportunity. Now, all the numbers we're going to use, the property, the policy loan, the bank loan, expenses, all those things, taxes, these are all just examples. This is not specific financial advice on a specific deal of any sort, nor is it tax advice of any sort. They're just things that might be representative and will absolutely be different than the situation, but it's one in which we can talk about the various parameters you're going to be seeing when you do this for real and how they will change when you apply your numbers in your situation. What we're going to be starting with is evaluating the opportunity as an opportunity, and then looking at different methods for acquiring the asset, not using privatized banking, and then using privatized banking and maybe another variation of that. We're going to be using this tool, and some of my clients have seen me use this tool with their situation. It's part of a suite of tools for doing financial analysis. This one here is specifically geared to looking at real estate investing for cash flow or for appreciation, for commercial or for residential, and takes in all those factors. If you're going to be doing a lot of this kind of stuff, and if you want to buy this tool, and I do not get paid a dime if you do, let me know and I'll get you in touch with the website where you can acquire it. If you're just working with me, then you can use my copy and we'll work on it together and do the analysis together. There's a lot of numbers here and it can be quite daunting. So we're going to be focusing on specific sections one at a time to show how we'd go through evaluating a real estate opportunity. The first thing we're going to do is look at the property. So I've just made up a property that's worth $300,000. And because we're not going to get a deal on it, the price is $300,000. So you could see if you were a good negotiator, you might pay less for something that's worth more. But we're not going to do that here. We're going to assume $5,000 in closing costs. Again, just an assumption, which gives us total purchase price that we have to come up with is $305,000. Now we're going to put in a land value of $100,000, leaving the value of the structures at $200,000. And we're going to take as a basis for depreciation, which will affect our taxes and what happens if and when we sell it. The basis for depreciation is going to be also $200,000. Let's talk about acquiring the property with the first mortgage. We are going to use a loan amount of $240,000. Why $240,000? Because we're going to assume a 20% or $60,000 down payment so that we would avoid, in many cases, PMI or mortgage insurance payment. Now, you might have a situation where you have access to a commercial loan, like with a VA that doesn't require that. We're just going to assume a 20% down. We're going to assume 4% mortgage rate. Can you do better? I don't know. And we're going to do a 30-year conventional mortgage, which will yield us a monthly loan payment of $1,146. Next, we'll look at the expense and income part of the analysis. At the top, the mortgage payment is filled in for us. We're going to put in on a monthly basis the property taxes, again, in your area, more or less, who knows, the insurance, and $50 for maintenance every month. You could say, well, it's way too much, or again, just an assumption. all these expenses here are assumptions, and ones which you have to really sharpen your pencil and understand what it is you're buying. There could be HOA fees, depending upon the state or locale you're in. As a landlord, you may be required to pay some of the utilities on a monthly basis. So you'll have to estimate that. If you get into a multi-family, multi-unit, you may want to seriously consider having a professional property manager, which will cost you something per month. The other aspects of expenses, and this is kind of a way to build it into your budget, is looking at vacancies. Is this thing going to always be generating rent every single month on every single unit within the property? And then when you have changes in tenants, there may be refurbishment costs and perhaps other legal costs in dealing with changing people who are renting from you. So these are all things you have to know and study. No matter how you finance this, you are going to need to make a good estimate as to what is appropriate for you. Finally, we get around to the income side, and this may assume that all units are rented 12 months a year, and this may be your gross rental income, and you can deal with the other issues in the expenses section above. Or you can build that into your average monthly income. Either way, just as long as you understand the assumptions you're making about the income of the property. Down here in this next section, we're going to put in some assumptions about the composite income tax bracket for you. And I'm just going to assume 30%. That's going to be composite, state, federal. The capital gains tax bracket, 15%, assuming that if you're not a flipper within the same year, your capital gains will be at the lower rate. And a tax you may not be familiar with, which is depreciation recapture at 25%. In the case in which you sell the property, which we're not going to do in this example, will be the amount that you're going to be taxed if you overdepreciate based upon selling the property for a profit. But that's just here for your future reference. So finally, we're going to come to the last column in the tool. We'll put in the months for the analysis of the investment, which was 5 years or 60 months. We have a 0 property appreciation rate. That is, compared to everybody else who talks to you about real estate, we're just going to assume that this thing is not going to appreciate in sale value. So this is looking at a cash flow opportunity just on the merits of the cash flow, not hoping or planning that the property is going to appreciate. Will the property appreciate always? Well, there was a thing called 2008. So that kind of broke that assumption. And other factors could come into play as well. But the whole idea here is to evaluate the deal as a cash flow deal. So we're going to assume 0. The last input we will put in here is years for depreciation, which is 28 years for a residential property. It's different for commercial. And the system will then calculate for us the tax deductions we have based upon depreciation, upon the tax deductibility of the interest of the first mortgage, and give us a net monthly cash flow utilizing those deductions as well, even though this is not tax advice, of $1,000 So it's positive cash flow based upon these assumptions. The other thing the tool does for us is gives us a rate of return. This is a figure of merit used by people with some additional financial background. It represents the speed at which your outlay of money comes back to you. Is it for our outlay of $65,000 on an annualized basis? How much of that comes back to us on average every year? And we'll compare this rate of return to perhaps other methods that might improve this number. So if you don't get it, don't worry about it. We'll just touch upon it lightly during this example. So to summarize, this is what we call a cash deal or cash down deal. In 5 years, you're going to take $65,000 out of pocket. Remember, it was $5,000 closing expenses plus $60,000 for that 20% down payment against the $300,000. And we're going to make, based upon our assumptions, $1,047 a month for 60 months for 5 years, which will yield $62,820. Now, is this a good deal? Do people do this kind of deal? Sure, every day. But could we do better? Well, let's see how we could do that. Let's now assume we have access to that down payment of $60,000, say from a policy loan using your privatized bank. And we're going to assume a loan rate of 5%. Policy loans these days go from 5 to 8% here in 2020. Again, that's very specific to your policy. And we're going to assume that we're going to pay ourselves back every month in a similar way that we would pay back the first mortgage on a 30-year loan, which will yield a monthly loan payment of $322. Income and expenses remain the same, except now we have another loan, which means now we have more money being paid back. Let's look at the investment analysis now. But now we've got more interest being paid, and the taxes are reduced somewhat because now we're writing off the interest on the second loan, which now changes the monthly cash flow to $797. Interestingly enough, if we look at the rate of return, that's gone up to 231 plus percent. Remember, it was 21% before? What's happening? Well, leverage is happening. Using privatized banking in that same 5 years, now we're going to take $5,000 out of our pocket. Remember, it was $65,000 before? We're going to take $5,000 out of our pocket, and we're going to get $797 times 60 months, $47,820. We've leveraged $5,000 to get us into a $300,000 property. And in 5 years, we've got $47,820, where before we took $65,000 out of our pocket and got $63,000 plus something back. Now, which deal do you think you'd like to do? Well, there's certainly a lot of advantages to this. And do people do this with other kind of loans every day? Sure. Do they do it using privatized banking? Absolutely. Let's look further into what this means. The policy loan we used was based on an example policy, which I just made up. It doesn't belong to any of my clients, anybody I know, nobody real. I made up a fictitious 45-year-old male who had a $20,000 annual premium set up like a banking policy. And that policy was had enough cash value in it to take out this loan at year 5. Now, this is not like yours. If yours is smaller, don't worry about it. This is all just scaling, right? You don't have to have that much property. You don't have to have bought that property under these conditions. Everything can be different. This is just an example where I was able to figure out, make it a policy to give me $60,000 where I could use in this example. So don't compare yourself to anything here. We're just showing how to structure things. We are also assuming the non-guaranteed dividends. So in this case here, we'll have a cash value of 64,000 something dollars, and we can take out 60,000 on a policy loan. Here's an example of us taking out this loan at year 5, and you'll see the cash value there at the top right corner of 64,841. In that next year, we're going to take out the 60,000, but we're also going to begin to start paying back immediately. That's why it doesn't say $60,000. It'll say 56 something because we're starting to pay back. And we're paying it back monthly to the tune of $322 a month, which equals $38.65 per year. And so we see that after 3 years of paying ourselves back, our cash value is now back up where it was before, and plus, because we've been contributing to the policy has growth inside of it, and we're paying ourselves back, that we are now in a position to do the same thing we just did with another property. So having access to this cash in 3 years is also part of our plan. It's not just to buy one property, but to be in a position to buy a second property or to combine them and buy a bigger property. You see what's happening here. Some people talk about paying yourself back faster. Nelson Nash talks about paying yourself more interest. I'm not going to talk about that in terms of paying yourself more interest because that implies something you're going to do with tax deductibility. I'm not going to offer any tax advice, so that's up to you and your CPA and your tax lawyer to figure out. However, it is very clear we can talk about paying ourselves back faster to enable our real estate business to acquire more property faster. Under our original plan, we were paying back that $60,000 loan on a monthly basis as if it was a 30-year loan. What are you going to do with that $797 a month? Shouldn't you be putting that back into your business? I mean, if you're not living on this money, are you just spending it? Is that a good banking principle? No judgment here, but let's talk about paying ourselves back faster and see what happens. Let's change our second mortgage payback, which is the policy loan. So let's consider paying back as if we had a 12-year or 144-month term. That will give us the equivalent monthly loan payment of paying as much interest times 2, which is actually going to the principal, which equals a monthly loan payment of $555. Now when we look at the investment analysis, again, everything else is the same. Our monthly cash flow has gone down to, coincidentally, $555. I didn't plan that. It just happened. But so we went from $797 to $555. So what does that mean? Well, it does mean that we are reducing our rate of return a little bit, but okay, what does that mean? Probably not a whole lot here. But if we pay ourselves back faster, that is, we're doubling the interest component, and it's just an arbitrary thing to kind of simulate paying ourselves back at 10%. Our new cash flow is less, but we're going to recover all of our cash value in 2 years. Remember it was 3 before? And if you hold this thing till it's completely paid off, it'll be paid off in about 9 years, given this particular insurance company's projections. So is it a good thing to pay yourself back faster? Well, look at your business. Ask yourself, what are you going to do with your net positive cash flow, and where's the best place that it can be? I'm not telling you to put all of it back into the policy loan. Here we put a little bit in. And look what it did for us. You could put in more and cycle the money through your privatized bank faster and move to a position of being able to finance the second property. This is how you make your real estate business really fly. Let's summarize the risk and control aspects here. We're using leverage, which means we've got a very small lever of $5,000 and we're controlling an asset of $300,000, which is throwing off profits to us. The question is, whose money do you use? Now, could you have gotten that second mortgage from another bank? Sure. But would you rather get it from your own? Because the control is what's important. Who controls the terms of that loan? Because there are risks inherent in this investment and all investments. That's the nature of investment. There are risks. The risks of vacancies, unexpected costs, etc. Things you might not have planned for. How you respond to those risks, what you can do with those risks. Well, here's the most important one that I can think of, is if, say, you have a terrible set of vacancies. Every month, what do we have to pay? Well, we have to pay the basic first mortgages, insurance, etc. But do we have to pay on the second? No, we don't. Why? Because we control the terms of the payback. And not only that, if we have other cash value in our policy, we can use that to pay the first mortgage and not have to dip into our family's normal operating expenses or budgets. So you can make your real estate business whole unto itself. It doesn't have to go outside into your other financial assets to keep itself healthy until we're back into a position of getting all of the income that we wanted and planned upon and start readjusting our payback schedule to meet the further future goals. Your privatized bank is that safety fund for all of those unexpected risks that you encounter in this form of investment. Let's summarize what we've gone through here. The most important part that I want to impress upon you is not all this financing aspect, but the deal itself. You have to do the homework and research on the property, on the rental environment, on the risks, on the other factors, on the other costs, to make sure you understand completely what your possible upside and downside is. Only you can do this. And you owe it to yourself and your money and your family and your business to make sure you understand that. Once you do, then using your private bank and thinking both like a banker and a real estate business owner, you're going to do the right thing. If it's bad on paper, don't plan on it getting better. Or don't hope that it's just going to get better because you want it to. That's why we use no appreciation. We're not counting on that. Because your situation will be unique and different. But with the structure of looking at the property, the finance mechanisms, the inflows and outflows of money will give you a far better idea on how to enter this very important asset class using privatized banking. So if you don't have a privatized bank right now and want to get involved in this, or if you have one and you want to get involved in this, then contact me at myfreedombank.com and we can start towards your real estate investing future.